Hello class, this is chapter 4 lecture for accounting 201, the accounting cycle. So the learning objective for this chapter, describe the flow of accounting information from the unadjusted trial balance to the adjusted trial balance and then onto the financial statements. Objective 2, prepare financial statements from adjusted account balances. 3, prepare closing entries. 4, describe the accounting cycle. 5, illustrate the accounting cycle for one period. Describe and illustrate the use of working capital and the current ratio and evaluate a company's financial condition. Let's see, there's application 1, describe and illustrate the end of period spreadsheet. Objective 2 or objective application 2 is describe and illustrate the use of reversing entries. So the end of period spreadsheet and flow of accounting data. As you can tell, here's the spreadsheet for this NetSolutions. There's an unadjusted balance right here in this 2 columns. Then there's adjustments, and then over to the right there's the adjusted trial balance. So once you have your adjusted trial balance, you can take your income or your revenue and your expenses and put those onto your income statement. You can take the equity section of it and put it into your statement of stockholders equity or owner's equity. Don't forget, your income statement does close out into your statement of owner's equity, and then usually the top portion, your assets and liabilities, end up going straight to the balance sheet, and then your owner's equity closes out the bottom of your balance sheet. Okay, so the end of period spreadsheet on the previous slide begins with the unadjusted trial balance, basically what I just went through and explained to you. Okay, so I won't go through that one. So the adjustment are normally entered in the order of which the data are assembled. If the titles of the accounts to be adjusted do not appear in the unadjusted trial balance, the accounts are inserted in the proper order in the account title column. The total of the adjustment columns verifies that the debits equal credits for the adjusting entries. The total of the debit column must equal the total of the credit column. Even if we make adjustments, those have to be true as well. Okay, so keep that in mind. Those have to be true. They have to be equal. So the adjustments in the spreadsheet are added and subtracted in the unadjusted trial balance columns to arrive at the amounts inserted in the adjusted trial balance column. The totals of the adjusted trial balance columns verify that the totals of the debit and credits balances are equal after adjustments. So as the end of period spreadsheet slide shows, the accounts from the adjusted trial balance flow into the financial statements. I already went through that whenever I was on that particular page, so I'll just go ahead and skip those. Let's see, so the income statement, here's your revenues, fees earned, and then rent revenue, and then all of your expenses are listed. Now, I did see some homework where revenues was put together and expenses were put together. Please keep them separate. You need to list out each of your accounts separately. Your expenses need to be listed separately for tax purposes and things of that nature. So keep in mind, if there is a surplus, or if your revenues are greater than your expenses, then you have a net income. If your expenses are greater than your revenue, then you have a net loss. Okay, I just went over this and what this meant, but I'll just go ahead and skip that slide. So statement of stockholders equity, there's common stock and there's also retained earnings, and then that closes out. Again, this closes, our net income is brought in right here, and these numbers will close out to the balance sheet. Okay, so disregard the dog barking. So this is statement of stockholders equity. It's a little chihuahua. He's barking in here. So, okay, so this also demonstrated what I was talking about, the common stock and retained earnings. I'm kind of getting ahead of myself. whenever I'm talking about these statements, financial statements. So there again, here's the balance sheet. The breakdown lists all of the accounts, and notice how this has current assets on it now, and this is our non-current assets, or long-term assets, or assets that can't be converted to cash quickly. So our current assets are accounts that can be converted to cash quickly. So then our total assets, 29,495, and then our liabilities, account payable. Our account payable will also be, or liabilities will also be listed from current to longer term liabilities. So we'll get into more depth in that later in this chapter. Actually, not chapter, but book. Then our common stock, or our stakeholders' equity. So the combination of our liabilities and our equity equals 29,495. And again, it's just a checks and balance that's built in. Okay, I actually already talked about this already. Maybe I should just hold off. Balance sheet, assets, liabilities, current assets. Current assets are cash, notes receivable, accounts receivable, supplies, and other prepaid expenses. Notes receivable, okay, that's also another current asset. Property, plant, and equipment, those are fixed assets, and plant assets, those are not considered current assets. Current liabilities, notes payable, accounts payable, wages payable, interest payable, taxes payable, and unearned fees, those are all current liabilities. And then the long-term liabilities, those are long-term notes, things of that nature. Stockholders' equity, again, right of the assets of the business is presented on the balance sheet below the liability section. Stockholders' equity is added to the total liabilities, and this total must equal the total assets. So on this particular slide, it says these are common stock is 175, depreciation expenses 25,000, dividend 6,000, fees earned 312,000, miscellaneous expenses 8,500, rent expenses 20,000, salaries 165,000, supplies expense 15,500. So it says on January 1st, 2012 or 2022, retained earnings had a balance of 100,000. During year 2012, common stock of 50,000 was issued. Prepare income statements and statement of owner's equity. So this is what it would look like. So earned fees 312,000 minus all of our expenses of 252,000 from 312 leaves us 60,000 in net income. So that closes out into our total net income. So right on there, notice how it goes into retained earnings right here. Our common stock is 125,000. We issued more common stock because we needed more. We need more cash, probably is what happened. So the total of the common stock balance, retained earnings, so that ends up going to 225 plus our new issued common stock of 50,000 plus our net income minus our dividends that we paid of 6,000 equals $329,000 for our stockholders' equity. Permanent accounts, balances of the accounts report on the balance sheet are carried forward from year to year, even from month to month, period to period, or half a year to half a year. Because they're relatively permanent, they are called permanent accounts or real accounts. Temporary accounts, accounts that report amounts for only one period, are called temporary accounts or nominal accounts. Temporary accounts are carried forward from year to year because they relate to only one period. This includes all accounts reported on the income statement as well as dividends account, which is reported on the statement of stockholders' equity. So closing entries at the beginning of the next accounting period, temporary accounts should have zero balances. To achieve this, temporary account balances are transferred to permanent accounts at the end of the accounting period through journal entries. The entries that transfer these balances are called closing entries, and the process of transferring is called closing process, and is sometimes called closing the books. So closing out a month, closing out the period, closing out a half a year, closing out a quarter, closing out, those are just some examples. After the closing entries are posted, all of the temporary accounts have a zero balance. So closing entry process involves the following two steps. First one is revenue and expense accounts are transferred to the retained earnings account. Okay. And step two, the balance of the dividends account is transferred to retained earnings as well. And so the two closing entries required the closing process are as follows. Debit each revenue account for its balance, credit each expense account for its balance, and credit net income or debit net loss, the retained earnings account. So that's a little confusing, but if you look at it, you'll understand what that means. Debit the retained earnings account for the balances of the dividends account and credit the dividends account for its balances. So closing entries are reported immediately following the adjustment. So here's the flow chart of what this looks like. So again, these all have balances in here. So the balance is 45. Notice this is a debit. So we're to zero those out. We're actually crediting those. Okay. So that's important. Same with this one. There's a balance of 4,000. We're going to do a credit. See how there's a credit here, but we're debiting retained earnings. And let's see our revenue accounts. So because it has a balance, a credit balance, we have to do an adjustment of the balance. Is going to be a debit balance, which closes straight to revenue. So then our revenue minus our total expenses gives us that 7,105. Now, keep in mind here, we're having to close this out onto so this will be a debit, which means we'll have a credit and retained earnings. So then the difference between those two, those will go on to our retained earnings. Okay, let's see. Closing entries, so what I just talked about, so our fees, each of those accounts that we were talking about right here, all of those are listed in this fashion. And then our fees earned and rent revenue, fees earned and rent revenue, fees earned and rent revenue, those are put on the debit. Notice on here, this is the debit I'm talking about because it's closing out those accounts to zero. Okay, and then retained earnings of 4,000 and dividends, that's where this is going right there. All right, so those are the closing entries for those. And these, a lot of times, these are called your income statement adjustments or your equity adjustments. So ledger with closing entries, this is also in the book, but this is a balance of all of the accounts. Okay, and then this is ledger with closing entries. And if you look on those, very similar to what we just did, we're closing those entries out as well. So if you zoom in on that, or you can look in on your book and you can see how those work. So check up corner. So after the accounts have been adjusted at December 31, the end of the fiscal year, the following balances are taken from the ledger: retained earnings $615,850, dividends, fees earned, wages expense, rent expense, supplies expense, miscellaneous. So we'll journalize the closing entries as follows. So fees earned $380,450, wage expense, rent expense, all of those expenses, and then our retained earnings, and that goes to dividends. We're crediting dividends and debiting retained earnings. Okay, so that's what that would look like. And let's see. So post-closing trial balances is prepared after the closing entries have been posted. The purpose of the post-closing, after the closing trial balance, is to verify that the ledger is in balance at the beginning of the next period. So here's what the post-closing trial balance will look like. Cash account is for $2,065, and then also our other credit balances on the right-hand side in the credit column. So the $29,545 does equal the $29,545 on the credit balances. So those do equal. So that's called a post-closing trial balance. So the accounting process begins with analyzing and journalizing transaction and ends with post-closing trial balances. And this is the complete accounting cycle. I'll try to do a follow-up video to show you all of the how you close out your books for a period or a month. So I'll do a follow-up video. So the accounting cycle, here are the 5 steps, and I think in chapter 1 we talk about the accounting cycle. So transactions are analyzed and recorded in the journal, transactions are posted to the ledger, and unadjusted trial balance is prepared, adjustment data are assembled and analyzed, and then an optional end of period spreadsheet is prepared. And then adjusting entries are journalized and posted to the ledger, step 7, and adjusted trial balance is prepared, then financial statements are prepared, then the closing entries are journalized and posted to the ledger, and then a post-closing trial balance is prepared. Okay, so that's the complete cycle. Again, accounting cycle takes all the transactions, which we looked at in chapter 1. In chapter 2, we looked at the rules of debit and credit, the balance sheet, analyzing, and then we come up with the unadjusted trial balance. And then chapter 3 looked at adjusting entries that we need to make. Chapter 4 looks at the financial statements and the closing entries. So that's the accounting cycle. So illustration of the accounting cycle, the following slides will provide an illustration of the accounting cycle for Kelly Consulting chart of accounts, journal entries, unadjusted trial balance, and end of period spreadsheet. So illustration, slide 2, adjusting entries, adjusted trial balance, financial statements, closing entries, post-closing entries, and ledger. Okay, so here are our accounts, and here are our other accounts. So here's the journal entries. So cash, and then account receivable, supplies, and then our common stock credited for that amount. So these right here should add up to 300 or 30,000. Prepaid rent. Oops, sorry, didn't mean to hit the camera. Prepaid rent, we did pay it, and so cash is 4,800. Prepaid insurance 1,800, cash 1,800. So those are all the journal entries. And then let's see. Journal entries again, cash, looks like we received cash for fees earned. Right here we bought some supplies and paid cash. Right here we did earn fees, but we put it on credit, so it's account receivable. This one we received cash and got paid with cash for fees that we did. And then for this one, we received cash on the account there must have been a balance in the account receivable. And then right here we paid salaries of $750, and then miscellaneous expenses were paid with our cash account. Let's see, so these are the journal entries for, again, miscellaneous expenses. As you can tell we're paying cash right here, paying cash for miscellaneous expenses. We're collecting cash here for fees, and we did some work, and then we actually put it on an account for someone to pay, and then we paid a dividend of $6,000, and that came out of our cash account. So here's all of those transactions that we just did. So they total our debits, so our $56,750, our credit balance of $56,750. So they did equal, so that's good. So after we go to the trial balance, here's our end of period spreadsheet for Kelly Consulting, and so your adjustments. So this is where we looked at. We started with 2,200, but we had an adjustment of 850, so actual on hand would be 1,350. And then our prepaid insurance, our beginning balance was 4,800, so we used 1,600 of it. So then now we have a balance of 3,200. Same with prepaid insurance, we had 1,800, we used 300, so now our new balance for the next cycle is 1,500. Office equipment stays the same. Our accumulated depreciation for our office equipment is 330. Our account payable stayed the same. Our salaries payable We did pay a salary of $120 that goes on to our expense. And then let's see, so these are all of our adjustment. So these are some of the fees that we had, some of the expenses that we had. So then these are our adjusted trial balance. So they still balance with 57,200 and 57,200. So adjusting entries, Kelly Consulting. So it looks like we are adjusting and closing these out. So then those are the adjustments, and then whenever we look at our adjusted trial balance, we still get 57,200. So what's going on is these accounts right here, these adjustments are what we just journalized. So when we have our adjustments, those adjustments are journalized right here. For example, 2,500, 2,500. So debit, unearned fees, and credit, fees earned. So debit, unearned fees, and then fees earned. Okay, so that's how we got those adjusting entries whenever we actually create the journal entries. So here's again, this 57,200 is this 57,200 right here, and that's where we get this adjusted trial balance on the end of April of 2018, I guess. So our financial statements now, our fees earned totaled 23,450. Our expenses were totaled 5,150, and then our net income is 18,300. Now that goes down to our statement of stockholders' equity, our common stock, and our retained earnings. So that closed out, and so our balance is 42,300. Okay, now that's going to go onto our balance sheet in that manner, in that fashion. Closing entries for our fees earned. Okay, we're closing those, and then we're closing out all of our expenses. We're closing out retained earnings and dividends as well. And here's what those look like. Oh, no, these are our post-closing trial balances. So 4650 and 4650, so they do equal. Okay, and let's see. So here's the ledger of those accounts, and these are all the transactions in April. And I don't know if you noticed this, but this is a running from chapters 1, I think it was chapters 1, 2, and 3. So some of these are running totals from previous chapters. Okay. Here's the other office equipment all the way down to salaries expense. So that includes some assets, some liabilities, some fees, some revenue accounts, some expense accounts, and also our equity accounts. And here's the ledger as well: account, rent expense, insurance expense, miscellaneous. And these are all expense accounts. These are income statement accounts. Accumulated depreciation expense as well. Okay, let's see. Analysis for decision making. Working capital and current ratio is the liability to convert assets into cash is called liquidity. So the accounts are whichever ones are most liquid, that's called liquidity. High liquidity is important. The ability of a business to pay its debts is called solvency. Okay, so however many assets you have to pay off your debt, that's, we call that the current ratio as well. Two financial measures for evaluating a business's short-term liquidity and solvency are working capital and the current ratio. So I just talked about that. So working capital is the excess of the current assets of a business over its current liabilities. So working capital is computed as follows: working capital equal current assets minus current liabilities. A positive working capital implies that the business is able to pay its current liabilities and is solvent. Okay. Now, so then, for example, so we took our current assets of 7745 minus 1390 equals 6,355. So that number that shows our our current assets minus our current liabilities. So that's one important thing that we look at whenever we look at a balance sheet. So current ratio is current assets over liability. Okay, and so that's the current ratio. So the example with this particular example will be 7,745 divided by 1,390. So approximately 5.6. And just a little inside tip. NAPI's current ratio up at the farm, dock and saw up on the hill in Farmington, this number, their current assets over current liabilities, is 9. It usually hovers from 8 to 9. So it's a very, very company that's being run pretty well. So let's see, end of the period spreadsheets. Spreadsheets are usually prepared by using Excel. I mean, we've been using Excel for this class as well. Some accounts prefer to expand the end of period spreadsheet to include financial statements columns as well. Okay, so steps in preparing expanded end of period spreadsheet: enter the title, enter the unadjusted. So I won't read through all of those, but extended the accounts to the income statement, total income statements and balance sheet columns, compute the net income or net loss, and complete the spreadsheet. So here's what it would look like. So here's the income statements and here's the balance sheet, and all of these close out nicely. Okay, so if it was the income statement, the cash, these liabilities would not go on the income statement. These accounts would go over here on a balance sheet. Now the income statement ones would be your revenue, common stock, dividends, all the way down. Those ones would go on your income statement. And don't forget, your revenues minus your expenses, and your equity will go on your balance sheet down here at the bottom. Okay, so those are just adjustments. So those are the unadjusted trial balances. So then we took these and minus any of our adjustments or added them depending on if it was revenue or anything like that. So that's how we get our adjustments. And then notice how, I just talked about this too. So then these accounts close out over here. And then these are our balance sheet accounts, which are assets and liabilities. And then the difference right there, that closes out over here into our net income. Okay, so it's really nice how it is very symmetrical and it closes out nice and neatly. So preparing the financial statements from the spreadsheet. So I'll go ahead and let you read that. Reversing entries, just in case. Accrued wages, let's see. Again, we kind of went over this, I believe, in Chapter 2, as far as how we take into account wages and wages earned and wages payable. So wages, accrued wages for December 31 and December 31 of 250 recorded with the following adjustments: wages expense 250, wages payable 250. Okay, so we'll reverse that, and there it is. There's the adjustment, credit, and then wages expense down here, adjustment 250. Okay, so we're pulling it out of as a liability now. So here's the reverse: wages payable 250, wage expense. We reverse the entry. Now we're paying it is what's going on. Wage expense and wages payable after reverse entry. So then notice how our account payable, our wages payable account, is now zeroed out. But now it's because of that we actually put it in our expense, wage expense. So it actually shows up. Let's see, reverse entry. Again, wage expense credit balance activity is only temporary. It will have a debit balance of $1,025. 1275 minus 250. As soon as the first payroll is paid on January 10th, the debit balance of 1025 is the correct wage expense for January 1 through 10. So that's the end of this chapter. If you have any questions, please please email me and I can make a video if you need me to explain something in more detail. But I hope you enjoy this class and let me know if you need help. Don't forget, all assignments are due the week after. They're usually due Monday midnight. So also discussion posts are due Monday midnight as well. So hopefully this helps out. Thank you and happy accounting.